spiking inflation, interest hikes, the war in Ukraine, Russia sanctions, and China's zero-COVID policies. Yes, the post-pandemic world is shaping up nicely. So, to take your mind off the reports of an upcoming recession, sit back and relax while we take you through the top 5 economic crises in history. The British credit crisis of 1772. As modern society started relying more on money rather than farming, new disasters began to present themselves in the place of crop failure. Like many financial crises, the credit crisis of 1772 struck after a period of optimistic credit expansion. Through colonial invasion and worldwide trade, the British Empire had accumulated a vast amount of wealth, which led to some overconfident speculation by bankers. Sound familiar? The London Bank of Neil, James, Fordyce and Down lost around £300,000 on stock invested in the East India Trading Company. Bad administration caused the once prominent company's finances to collapse. In turn, this led to banker Alexander Fordyce absconding to France to avoid paying his debts. The bank's collapse had a domino effect on many of the other private banks, and the panic caused bank runs and a liquidity crisis. Creditors began to form lines outside British banks, demanding instant cash withdrawals. Credit was restricted, and the disaster spread havoc throughout the financial institutions of Scotland, Amsterdam, Hamburg, St. Petersburg, Genoa, Stockholm, Paris, and the British American colonies. Scholars still disagree over the underlying cause of the credit crisis, with some speculating that it was due to a lack of financial regulation, while others took the opposing argument. It is also unknown whether the directors of the East India Company manipulated stock in their favor or whether political turmoil increased the stock's volatility. It has been speculated that Fordyce's actions were not the true catalyst for the event. At that time, the European economy was debt-based rather than credit-based, and it is perfectly feasible that a single person who had racked up debts claimed insolvency and stopped paying. This seemingly inconspicuous event would have affected the creditors. The complex tapestry of debt began to unravel, causing the Bank of Neil, James, Fordyce and Down to look to the exchange market to make up for the losses. While the financial markets had all but recovered by the end of 1773, historians now think that the following economic repercussions of the crisis contributed to the Boston Tea Party protests and the American Revolution. The Great Depression, 1929 to 39. Many contributing factors led to the decade-long economic disaster named the Great Depression. Although the Great Depression severely impacted the world, we're going to take a look at the U.S. in this segment, for this is where the Depression got its notorious start. Coming after the decadence and frivolity of the Roaring '20s, the stock market crash of 1929 got the ball rolling on the worst economic disaster of the 20th century. Gradual stock price declines in October 1929 caused the bubble to burst, and Black Thursday saw the panic selling of stocks. Investors who had used loans to purchase stocks were forced into liquidation, further exacerbating the fall in stock prices. In less than 3 months, U.S. stock prices declined 33%. The market's crash led to people feeling uncertain about their financial future, which reduced the number of consumers purchasing durable goods, as well as causing a sharp fall in business investment. A series of banking panics followed the initial crash, in which depositors, fearful of their bank's solvency, demanded cash withdrawals of their funds. The withdrawals led to the hasty liquidation of loans, which meant even stable banks failed, and by 1933, 1/5 of the U.S. banks that were open in 1930 had failed. Many factors led to the banking panics, including the substantial increases in farmers' debt that had stemmed from the high prices of agricultural goods during World War I. Farmers then struggled to keep up loan repayments once the prices fell after the war ended. The Depression was then compounded by adverse weather conditions hitting the southern plains, causing crop failures. This led to dust storms that blew through farming communities, causing many homesteaders to lose their livelihoods. Further issues arose when the U.S. government tried to raise crop prices by paying farmers to produce less food. Crops already planted were dug up, and young livestock was killed to create more demand for produce. These issues meant that while the other countries affected by the downturn had recovered by 1933, the U.S. struggled until 1939. However, Many now believe that the real end of the recession came much later, as when World War II began in 1939. Unemployment declined only due to the increased military conscription. The OPEC oil price shock of 1973. This crisis may also cut a little close to home. It highlights the issues that arise when your society is almost entirely dependent on a finite resource. In 1973, President Nixon promised $2.2 billion in emergency aid to Israel following the Yom Kippur War. OPEC, the Organization of the Petroleum Exporting Countries, primarily made up of Arab nations, retaliated by instigating a series of production cuts that drove up the price of oil worldwide. They also placed an embargo on the U.S. and their allies, halting oil imports from OPEC countries. America suffered from oil shortages, and oil prices spiked from $2.90 per barrel to $11.65. This price increase came at a time when prices of wholesale industrial commodities were rising rapidly, and many industrial materials were in short supply. As the U.S. industrial plants were already operating at full capacity, it meant that the U.S. oil industry did not have the necessary means to increase oil production and meet the demand. As a result, the U.S. could do little to combat the price hike. The embargo also coincided with the devaluation of the dollar, which further exacerbated the issue. The oil crisis diminished America's international leverage, and the announcement of the oil embargo shocked the American people. It had serious implications for the economy, and many people thought the American way of life, with its sprawling suburban homes, big cars, and culture of consumption, was over. It also showed them that the U.S. government was perhaps not as all-powerful as they might have liked to believe. Coming at the tail end of the divisive Vietnam War, the oil crisis exacerbated the widespread inflation that was caused by the costly conflict. These events combined made many Americans question the presumed infallibility of their country. The Asian Crisis of 1997. This global financial crisis began in Thailand. On July 2, 1997, the Thai government ran out of foreign currency and could no longer support its exchange rate that had been pegged to the US dollar. The government was forced to float the Thai baht, making it volatile, and the exchange rate of the baht fell, collapsing the currency. The weakening of the baht set off a series of currency devaluations. Within the first 6 months, the South Korean won had dropped by 50%, the Indonesian rupiah by 80%, and the Malaysian ringgit was down by 45%. The hardest-hit economies saw a drop in over $100 billion in capital inflows in the first year. The crisis then spread to affect the Russian and Brazilian economies. The reasons behind this crisis are complicated and polarizing. Many consider that a major contributing factor was the collapse of the so-called hot money bubble. In the 10 years before the crisis, many Southeast Asian countries were able to achieve an increase of up to 12% in their GDP. This economic boost was due to foreign investment and an increase in exports. High interest rates and fixed currency exchange, pegging the currency to the US dollar, were implemented to attract hot money, which is money that investors sent around the world looking for the best rate of return. When the US raised its interest rate against inflation, it initiated a flow of hot money into the US, which caused the dollar to appreciate. The knock-on effect was that all the currencies linked to the dollar appreciated, which meant that the price of domestic services and goods increased, and exports began to fall. Foreign investors started to withdraw their money from these countries, which soon ran out of the foreign currency to support the exchange rate. Thailand was the first to be forced to float its currency, but soon the rest of the Asian countries followed suit. The Asian crisis had many political and social implications, with the biggest affecting what role the government should play in the financial market. Supporters of neoliberalism and free market capitalism felt that the crisis was a direct result of crony capitalism and government intervention. Many of the affected countries had to take aid from the International Monetary Fund and agree to structural adjustment packages that weakened the relationship between the capital market and the government. The financial crisis 2007 to 2008. 2007 saw the sequel to the Great Depression, dubbed the Great Recession. Although it lasted less than 2 years, it was America's longest and deepest economic downturn since the Great Depression. This financial crisis was triggered when the U.S. housing bubble burst in 2007. From 2001, Decreases in the interest rates that banks charged low-risk customers meant that millions of prospective homeowners, who could not have normally been able to afford a mortgage, could purchase properties. This access to loans flooded the market with first-time buyers, increasing the demand for properties and pushing up the cost of homes. When interest rates started to rise again, the demand for housing declined, causing house prices to fall. Homeowners with adjustable-rate mortgages found they could no longer keep up their mortgage payments, and they could not borrow money against their homes or sell them to pay off the mortgage. Many of the borrowers found that they owed more on their mortgage than the house was worth, which plunged them into negative equity. It is estimated that American households lost around $16 trillion in net worth, with 1/4 of households losing 75% of their net worth. The collapse of this market then affected the banks, as a large portion of their assets were in the form of subprime loans made at interest rates higher than prime rates. Banks started to doubt the solvency of other banks and introduced an interbank credit freeze. This freeze reduced the amount of credit available to businesses, which then reduced their expenditures, leading to job losses across the board. As unemployment and the underemployment rose, consumer demand diminished. It was then discovered that the portfolios of many banks and investment firms were based on toxic assets that were pretty much worthless. The revelation that these portfolios were largely fictional caused the companies to declare bankruptcy, merge with other firms, or seek government bailouts. Consumer confidence took a massive hit, and most Americans cut down on their spending. This reduced spending was another blow to the suffering business sector. The GDP declined by just over 4% during the recession, while unemployment figures doubled. The loss of wealth and recovery speed from this crisis varied based on socioeconomic class. This difference further widened the wealth gap in the U.S. According to one study, the richest 7% of households increased their net worth after the crisis by 28%. In contrast, the net worth of the lower 93% of Americans decreased by 4%. This financial crisis and subsequent recession spread into Western Europe through several major banks heavily invested in American mortgage-backed security. Historically high levels of personal debt and diminished job prospects for young adults continued to be an issue 13 years later. The chances are, if you are watching this video, you have lived through at least one of these economic disasters. If so, how did it affect you? Let us know your experience in the comments below. To learn more about famous economic declines, check out our book, The Great Depression, a captivating guide to the worldwide economic depression that began in the United States, including the Wall Street crash, FDR's New Deal, Hitler's rise, and more. It's available as an ebook, paperback, and audiobook. Also, grab your free mythology bundle ebook while it's still available. All links are in the description. If you enjoyed the video, please hit the like button and subscribe for more videos like this.